I just remember those days of listening to Greenspan just talk and talk and talk. And I was just like, I can't listen to this for more than 5 minutes. It drives me crazy.
It's pretty terrible, my friend. All right, so we selling strangles. We selling strangles. Is that what we're doing? Hey everybody, JC Peretz here, founder of All Star Charts, and I am joined once again by my esteemed colleague, Mr. Sean McLaughlin.
What is happening, man? You catching any whiplash from this rope-a-dope post-Fed minutes thing that's happening right now?
Was that today?
Yeah. It was news to me as well, but yeah, I guess the Fed released their minutes about 20 minutes ago. Market spiked up. Market spiked up for about 10 minutes and then just straight down. Oh well, that's how it goes.
Well, I learned recently that these are things that you read. In my head, it was like a podcast, like you listen to the minutes. Like in my head for all these years, that's how I thought it was. I don't know why I thought that. But no, as it turns out, the Fed minutes are not a podcast. Like I knew they weren't a podcast, but I figured you would consume them by listening to them. I don't know why I thought that, but that's not the case.
If it was a podcast, would you listen to it?
No.
Either would I.
Sounds like a terrible podcast.
I mean, I realize we've had many Fed chairmen since Greenspan, but I just remember those days of listening to Greenspan just talk and talk and talk. And I was just like, I can't listen to this for more than 5 minutes. It drives me crazy.
It's pretty terrible, my friend. All right, so we selling strangles. We selling strangles. Is that what we're doing? Yeah.
Well, look, we were talking this morning, had our little analyst meeting as we always do on Wednesdays. And, with one thing I observed, what I've been observing the last 2 days is while the VIX is certainly off the high levels that we were at a few weeks ago, the fact of the matter is the VIX has risen 30% since Monday's close. And to me, when you see a rise in volatility like that, my first instinct, my natural options trader instinct, is to go looking for premium to sell somewhere. So that's where we kind of landed today when we were talking. We had some other ideas, but none of them looked really that appealing compared to selling some premium. And you brought up the industrials. You liked that chart.
Well, because of the transports, right? Because remember, we're talking about how transports are getting killed. And it's like, man, the transports are down 2,000 points in a week. Like, let's sell some premium here. But the problem with the transports ETF is it's very liquid. It's super thin. So you can't do that. Now, oddly enough, all the stocks that are in the Dow Jones Transportation Index are in the industrial sector. It gets very confusing. But that's the XLI. It's the industrial sector where all the Dow transports live. So if you want to get exposure to transports, maybe take a look at the XLI. So that's exactly what we're doing here, right near a flat 200-day moving average. You can't see it here, but if you know markets and you see this nasty sideways mess, you could pretty much assume that there's a flat 200-day moving average there somewhere, and we're precisely right at it as we speak.
Yeah, so given today's action in XLI, now this is obviously X, what has ever happened in the last 30 minutes or so, but you can see we had a little gap down today, and the price action in XLI over the last 2 weeks, as you might imagine, as we've been selling off, it has juiced the premiums in the XLI options during this period of time. So two things that we liked here when we were looking at this chart. One, we liked that the implied volatilities were rising. That's always a good thing when you look to sell premium. But also we liked that, we felt like we could fade this move right here. And the 97 level that's highlighted here in the chart, I mean, this goes back to May of last year. I mean, this 97 level is pretty significant. We had a minor little freak out in late February. You can see pretty clearly on the chart where we traded below 97. But I mean, it quickly reversed, telling us that, yeah, 97 is a level that we need to deal with, and it's a pretty strong level. And on the flip side, the recent highs we had a week ago, 2 weeks ago, they feel like levels we could lean against pretty strongly. That's 105 that you see up there at the top.
We call that overhead supply, Shawnee boy.
We call that overhead supply. So when we started looking into the May options, which are approximately 6 weeks to expiration right now, there were some pretty nice premiums. If doing a straddle here, selling the 105 calls and selling the 97 puts, we were looking at being able to collect around a $2.85 credit, which felt like a pretty nice credit. It gave us a lot of room. It gives us room to be wrong. And look, all we need XLI to do is just stay within these bounds for the next, I don't know, 3 weeks, and we should have no trouble hitting our profit target. There you could see JC just put up the chart of the P&L graph of the trade. I mean, because of the 285 credit we're getting, we actually have room beyond our short strikes to still make money in this trade. So we have a lot of room to be wrong, JC, which I like. So that said, being short the 97 puts, we'll give XLI all the way down to 96. That's the level I'm watching for risk management purposes. If XLI breaks below 96, that's where I'm going to say, all right, no mas, we're cutting the trade. I'm not, the trade's not doing what I thought it would. I don't want to wrestle with it, so we'll close it down. Same thing on the upside. We're short the 105 calls, but we'll give it to 106. You know, if it breaks above 106, then same story. That's my clear indication that we're wrong, and I want to be out. And we'll most likely take a loss in that situation. Now it depends on the timing, of course. If we break above 105 or below 97 with, you know, a week till expiration, we might still be able to exit that trade with a profit. But that's not the bet I'm making. But hey, we're collecting 285 for the spread. My goal always when I'm doing short strangles, is I want to buy it back. I'm going to close the trade down at a profit when I could buy it back for half of what I collected up front. So I collected 285. I'm looking to buy it back for about $1.40. Just, you know, take the cream off the top. Let somebody else sweat those last nickels and dimes before expiration.
Yeah, so this is a situation where if we were to break out above those former highs, that would be pretty bullish. So a neutral strategy is not something we'd want to have. And if we start breaking this support going back a year, then that would be a bearish sort of development. And we wouldn't want to be neutral. We would want to be bearish. So we want to be neutral. As long as we're within this range, we want to bet that it's going to continue to stay in that range. With implied volatility up dramatically, we're able to collect more premium, which is why this particular strategy is leaning towards collecting premium versus paying that premium. And I like it. You know, I really like this for portfolio diversification, Sean. And before we get into it, let me just reiterate exactly what we're doing here. We are selling the XLI, which is the industrial. So we're selling a strangle. So the XLI May 97-105 strangle for approximately 285 net credit. That means we're short both the 97 puts and the 105 calls in May for XLI, which is the industrial sector index ETF. Now, from a portfolio construction standpoint, there's a lot of investors, the majority of investors, myself included, are leaning long, right? Equities, volatility, right? So this is a situation where you're shorting volatility, you're neutral in terms of direction, great complement to an otherwise much different portfolio.
Right. I mean, we've talked about this before. I like to have a variety of positions on in my account. And, you know, if I look across the positions I have on now, most of them are leaning bullish. We have a lot of like energy and oils and materials names on right now. And I don't like having a one-way portfolio, right? I don't have any bearish trades on right now, but I do have a few delta neutral trades like this, and that helps kind of provide some ballast to the portfolio, gives us ways to make money if stocks go sideways for a little while. It's just a good best practice to try to have a mix. I wish I had some more bearish trades on. I just haven't found any good ones that I like. I'm keeping an eye out for those just to provide balance to my portfolio, but it's just good to have a mix of directional bets, a good mix of strategies, whether it's long premium or short premium. It's always good to have a mix of durations as well. I mean, good to have trades that maybe only have 1 to 2 months till expiration, as well as trades that might have 9 to 12 months to expiration, or even longer, like those CVX leaps we have.
This is a great compliment, right? Isn't this a great compliment to the long CVX leaps? Because in that case, you know, you're long, you got a ton of duration. In this case, you're more neutral, short duration.
Yep. And when it comes to short premium trades, I definitely tend to always want to only put trades on that have no more than, let's say, 8 weeks until expiration, because the way options work is as you get closer to expiration, particularly once you get inside of say 30 days, the theta decay or the erosion of premium accelerates as you get closer and closer to expiration. And that's the part of the curve that we want to capture when we're selling premium. We want that theta to eat away at the premiums of those options as quickly as possible. So we try to stay, 4 to 6, no more than 8 weeks out to expiration when we put short premium trades on. For that reason.
Well, we're looking at what, about $1.40, $1.45. You can get that, call it a day.
Exactly. That's my plan.
All right. I love it. Ladies and gentlemen, Mr. Sean McLaughlin, we're putting on, we're selling the strangles. We selling strangles. We going to Sizzler. I love it, Sean. Listen, you have yourself a great day, ladies and gentlemen. Thank you for being here. I am JC Peretz, and this is Sean McLaughlin signing off.
Take care, everybody.
Adios.